Hey everyone and welcome. If you're just starting out in accounting, you have probably heard the word depreciation. It basically sounds a bit technical, but understanding it is fundamental to understanding business finance. My name is Swapnil from AU Study Group, and today we are going to break down exactly what depreciation means, why it happens, and the most common ways using business to calculate it. Ready? Let's just dive in. Okay, so what is depreciation? Imagine you buy a brand new delivery van for your business for say 20 lakhs. You know you will use it for several years, maybe say 5 years or 10 years. Will it still be worth 20 lakhs after 5 years? After all the deliveries, after wear and tear? Probably not, right? It loses value, right? That is what depreciation is. Okay, in accounting, depreciation is basically the process of spreading the cost of that van over its estimated useful life. Okay, it's basically how we show on paper that the asset is gradually being used up and contributing to earning revenue during those years. Okay, it's basically an expense recorded in the profit and loss account. Depreciation will be considered as an expense in your profit and loss account. Okay, but why do assets like our van basically lose value? Why do they lose value? Okay, there are a few main reasons. First, wear and tear. Simply using the asset causes it to physically deteriorate. The engine runs, the tires wear down, that's wear and tear. Okay, by using it more and more, the asset's value will decrease, that is wear and tear. Second is obsolescence. This means your product, your van is outdated. Okay, maybe a much more fuel efficient or electric van model is coming out. So your model, the van which you have, the asset which you have, okay, will make it less desirable or less efficient. It's become outdated. That is second reason. Third, simply passage of time. Okay, now even if not used heavily, time can lead to decay or make things seem older or less valuable. Imagine this, you have purchased a two-wheeler just 5 days back or just yesterday. You just purchased it, you didn't use it. You purchased a bike for say 1 lakh rupees, 1 lakh or 1 lakh 50,000. You purchased it, you didn't use it, you just kept it at your home. For some reason you didn't use it. After 1 month, if you want to sell the bike, will you get the new bike price? You will not, right? Anyone will not buy it for the same price, for the new bike price. They'll decrease, they'll ask for a discount of 10,000, 15,000 or 5,000. Okay, that is the reason, that is the passage of time. Okay, as the time passes by, the value of the asset decreases. Now, fourth, specifically for natural resources like say a coal mine or an oil well, there is depletion. As you extract the coal or oil, the value of the resource naturally goes down because there is less left. That is depletion. Okay, now next go to why actually it is important to record depreciation in accounting. Okay, it boils down to getting an accurate picture of the business. Okay, the matching principle. Now if you understand the matching principles, we have already done a video on accounting concepts and conventions. Okay, you can watch in that the brief description about matching principle. Now the matching principle basically means we want to match expenses with the revenues they help generate. Now the van, the example what we took, the van helps makes more deliveries. That is basically it is helping us to generate revenue for years. So we are spreading it costs over those years. For example, if the van we have used to earn revenue for 5 years, for 10 years. So in these 10 years, every year we write some part of van. That is depreciation. So matching principle. Okay. Now this also gives us a more accurate profit calculation. if we didn't account for the vans wearing out, our profit would look basically artificially high. Okay, that is second reason. It also means that the balance sheet shows a more realistic asset value, not the original cost forever. I have purchased the van for 20 lakhs. Every year I will not show 20 lakhs in my balance sheet. Okay, I have to decrease because I have used it. Because if I sell it now, it will not be for 20 lakhs. Okay, so to make more realistic asset value, we basically record depreciation. Okay, another main reason is, now depreciation is a tax deductible expense. We can claim deduction, we can claim tax deduction as depreciation. Okay, now businessmen, they care, because if you put the depreciation in P&L account, your profits will decrease. You can show less profits and pay less taxes. Okay, that is why we should actually record depreciation. Now, how do we basically calculate the depreciation? How do we calculate it? We know it is depreciating. How do we calculate it? Okay, there are several methods, but we will basically focus on the big ones you will encounter first. These are 4 methods: straight line method, written down value method, annuity method, depletion method. There are other methods as well, but let's just focus on the big ones which are used majorly, okay, in the market. Now, straight line method. This is the simplest and often the most common used everywhere. Straight line does exactly what it sounds like. It just spreads the cost evenly. You take the asset's cost, subtract its estimated value at the end of its value, that is the scrap value, salvage value or scrap value, and divide it by the estimated useful life in year. Boom. Same depreciation amount every single year. The formula is cost of asset minus estimated salvage value or scrap value. Okay, divide by estimated useful life. Now let's take an example. Now, a 11,000 rupees machine lasting for say 5 years and which is scrap value of say 1,000. Okay, now what will be the depreciation per year? Good. 2,000. Now every year we just charge 2,000 rupees as depreciation. That is 11,000 minus 1,000. Cost of machinery, cost of our asset minus the salvage value or scrap value. 11 minus 1, 10 divided by 5. The total number of years what we expect to use it. Now 2,000 every year we charge it. Okay. Now the downside of this is every asset cannot be useful equally every year. Okay, for example, a van, first year it was very useful, very good. Okay, wear and tear was very less, it was fresh, it was new, so efficiency was good. In 9th year, will it be as useful as it was in the first year? No, right? So that is the downside of straight line method. Okay, that is the downside of straight line method. Now, next, we have the written down value method, WDV value, which is also called as reducing balance method. This works differently. It basically applies a fixed percentage rate to the assets book value every year. Okay, I'll repeat again. It basically applies a fixed percentage rate to the assets book value. What is book value? Book value means the original cost minus the depreciation already taken. Okay, already taken depreciation is deducted and then the percentage is calculated. Now since the book value every year decreases, the depreciation amount also decreases. Okay, let's actually do a small example, calculation example. The formula will be depreciation is equal to book value at the beginning of year into percentage. Okay, let's take an example. Now if our machine costs say 10,000 rupees and we use a 20% rate, in straight line method what we do, 10,000, if the cost is 10,000 minus our scrap value, divide by number of years, that's it. Okay. Now here, that if assuming the depreciation rate is 20%. So this year I have purchased a machine, say 10,000 rupees, depreciation 20%. So book value will be 8,000, but depreciation first year is 2,000. Very good. Depreciation is 2,000. Okay. Second year, what happens? Now the asset value is only 8,000. 10 minus 2,000 depreciation. Asset value is 8,000. So 8,000's 20% is 1,600. So the depreciation is 1,600. Okay. And in your balance sheet, you show the asset value as 6,400. Okay. Don't confuse it. Let's do it again. Okay. The first year, we are charging for 10,000, 20% every year we want to charge. So 10,000's 20% is 2,000. Depreciation 2,000. Now what is the value of the asset? 10 minus 2, 8,000. 8,000 is book value. Second year, 20% of 8,000 is your depreciation. So depreciation is 1,600. For third year, the book value will be asset value minus last year's depreciation, 6,400. The depreciation would be 20% of 6,400, 1,280. Very good. Okay. Now the book value will decrease. Okay. Now the amount decreases. It is a bit more complex to calculate, but often seen as more realistic for certain assets. Okay. Because here what we are doing is, first year it was like fully used. Second year we are not using it fully. I mean the asset value was decreased. Third year the asset value was more decreased. Fourth year the asset value was more decreased. That is the reason it is called reducing balance method or written down value method. Okay. Now quickly let's actually take two more methods. The annuity method. Now this annuity method is a bit more complex. It basically considers not just the cost reduction but also the interest cost on the money tied up in the asset. Okay, for example, if you are purchasing an asset on interest on a loan, the interest cost will also be depreciated. Okay, you usually see this in specific situations like long leases. Very long lease if you are taking, then you see these methods. For beginner, for now you just understand that, okay, that there is a method called annuity method and it includes an interest component. Just remember this, that should be sufficient. There is a method of depreciation which is called annuity method and it includes an interest component. That would be sufficient for you. Okay. Now the fourth part is depletion method. This one is strictly used for natural resources like say mines, oil wells, timber. So instead of time, depreciation basically is based on how much of the resource you extract each year. Okay. For example, you figure out a cost per unit like per ton of coal or barrel of oil and multiply that by the units extracted in the period. Okay, so depletion rate per unit will be cost of resource minus estimated salvage value divided by total estimated units. That is the depletion rate, and depletion expense will be the rate per units into total unit extracted in that period. Okay, that is the depletion method. Okay, example is this. The cost of mine is say 10 lakh. Now estimated extracted coal is, we have extracted 1 lakh tons of coal. Now what will be the depletion rate per ton? Depletion rate will be the cost of mine is 1 lakh. Total extracted coal is, cost of mine is 10 lakhs. Total extractable coal is 1 lakh tons. So 10 rupees per ton is the depletion rate. Okay. So if 5,000 tons are extracted in this year, all 1 lakh ton will not be extracted in 1 year, right? So it will take some time. It will take 10 years, 15 years, 20 years. So if this year 5,000 tons are extracted, depletion expenses will be 10 rupees into 5,000. If next year say 7,000 tons are extracted, 7,000 into 10, 70,000 will be depletion expenses. Okay. Now these are the 4 types of depletion methods. Just have a glance at difference between SLM and WDV method. SLM is straight line method, WDV is written down method. Okay. Now depreciation amount in SLM is constant. It's fixed every year. In WDV, it decreases every year. The calculation basis formula is in SLM cost minus salvage or scrap value, cost minus salvage value divided by life. WDV, its percentage of book value. Now book value is cost minus already accumulated depreciation. Already whatever depreciation we have claimed, that we deduct. Okay. Complexity. SLM is simple. WDV is a little more complex than SLM. Common usage. SLM is assets with even usage pattern. Okay, which are used very evenly on that asset. You used SLM. WDV, assets with higher initial efficiency. We use it WDV method there. Okay. Now remember this. What do we need to remember in depreciation? Now, understanding depreciation is a key building block in your accounting journey. It basically helps you make sense of financial statement and how businesses account for their long term. Okay. I hope this breakdown was helpful. If you have any questions, drop them in the comments below. I'll do my best to answer. If you have found this video useful, please give it a thumbs up. Subscribe for more accounting. Subscribe for more accounting basics to be explained very simply, and maybe share it with your fellow students. Okay. Thank you.